In the last 12 months, Abercrombie & Fitch's stock rose by 138%, outperforming even Nvidia, whose stock rose by 118%. While Nvidia is in a league of its own in the long term, it is fascinating that an apparel company could grow its market cap faster than a leading technology company. So let's find out what's behind this success and whether there is still an opportunity for us as investors. Abercrombie & Fitch was founded in 1892 as an outdoor goods store in New York City. The brand quickly gained popularity among the elite, with customers like Teddy Roosevelt or Ernest Hemingway. Although successful for many years, they faced bankruptcy in the 70s. The brand was revived in the 80s, transforming from an outdoor retailer to a fashion brand for young people. However, the company declined again at the beginning of the 21st century. In 2017, Fran Horowitz was appointed as the new CEO, and Abercrombie & Fitch underwent another transformation. The company shifted its focus to older customers, concentrated on quality, and downsized its stores to cut costs, leading to remarkable results. If you were to invest $1,000 into this company 10 years ago, you could buy around 23 shares. And now they would be worth something close to $3,394. And this company used to pay dividends, which they stopped in 2020. So since 2014, you would get just over $100 as dividends. So if we add together the current value of shares and the dividends, we get $3,495. And that is a gain of 249.5% in 10 years. Now, I don't know about you, but I wouldn't mind such results. Individual insiders, that is NX. 1.8% of the company is owned by individual insiders. And we would like to see this number over 2%, so that is very close, but not quite there. And are individual insiders buying? That is also NX. In the last year, we see a number of sale transactions from insiders. And do super investors own this company? That is a check with one super investor, and it is Lee Ainsley. But since he owns over 250 stocks, Abercrombie & Fitch makes up less than 0.1% of his portfolio, so it's not a meaningful bet. And is he buying right now? That is an X. In the last quarter, he sold almost 3,000 shares, which is a reduction of 13.8%. Well, we see that both insiders and super investors are not buying currently this stock, and that can be a sign that they believe it is overvalued. But we should not base our decisions only on what other people are doing. We have to base them on our own analysis, our own valuation, which we will get to in just a few minutes. Return on invested capital, that is an X at 2% 10-year median returns. And we want to see this number higher than 10%, so that is not a great start. And what do we know about net profit margin? It is an X averaging 2.4% over 5 years, and the sector median is 4.6%. But that does not tell the full story, because if we would look at the recent margin, we would see that it is at 10.8%, so over double the sector median. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 27.4% of shares. So the buyback program was massive. And that is great for long-term investors because without buying any more shares, they became owners of a much bigger portion of the company. And the debt, it is a check. It would take just over a year to pay the long-term debt with a 5-year average free cash flow. Now, I am not using the recent free cash flow because it is exceptionally high. Revenue growth, that is an X at 0.4% 10-year compound annual growth rate. And we would like to see this number higher than 10%. But next results will show you the power of cutting costs and buying back shares. Let's look at free cash flow growth. That is a check at 45.6% in the last 10 years. That is quite incredible. And earnings per share growth, that is also a check at 24.6% in the last 10 years. So even though the revenue is not growing a lot, the company is becoming extremely efficient. But we should also remember that growth results may be a bit misleading, as it sometimes is with cyclical industries. Abercrombie Fitch is not paying any dividends since 2020. That was one of the changes that was introduced to cut costs of the company, alongside the downsizing of shops and decreasing the amount of inventory. So instead of paying dividends, they concentrated on growth and buybacks. And it seems that it was absolutely the right thing to do because it created much more value for investors than what they would get from just dividends. Price to earnings ratio is 12.6, so not really that high. Maybe we will get something close to fair value. Let's use the discounted cash flow analysis to see. And we will be using a 5-year average free cash flow instead of the recent one. It is a cyclical company and the recent free cash flow is huge compared to what we saw in the past. So by using the 5-year average, we are trying to be more conservative and maybe more realistic. So first, we will have to estimate the future growth of this company. In the low scenario, we will estimate a growth of 9% for the first 5 years and then 7%. In the medium, 15% and then 12%. And in the high scenario, 20% and then 18% growth. The low scenario is close to the predicted growth of the industry, which is around 9.2%. Medium is showing a story in which Abercrombie Fitch is outperforming its peers, and the high one is closer to the recent growth of the company. So with such estimates, the intrinsic value in the low scenario is $82, in the medium $116, and in the high scenario, 166. But we have to always apply a margin of safety to those prices. The one I use is at 30%, but you can of course use a higher or lower one depending on your own preference. And with such a margin, we get in the low scenario $57, in the medium $81, and in the high one $116. And the current price is around 130. So Abercrombie Fitch seems to be overpriced, but it is not a crazy difference. So when we take a look at the overview in our Stock Ranking Pro, which you can get access to by becoming a Patreon, we see that financial health of Abercrombie Fitch is good, investors' sentiment is okay, but the growth is the real strength of this company. We know that its stock in the last year was up more than Nvidia, but let's see, is this company actually growing faster than Nvidia? Let's filter our stock ranking to show only Nvidia and Abercrombie Fitch, and we can see that revenue growth is much better for Nvidia, but when it comes to free cash flow and earnings per share, Abercrombie Fitch is actually growing faster in the last 10 years. So on one hand, we have a great CEO and a great brand and a very impressive growth. On the other hand, we have to remember that shifting consumer preferences could challenge Abercrombie's and Fitch ability to stay relevant. And their whole history shows just how cyclical this business can be. And there is really no reason to believe that this will change in the future. Thank you so much for watching and see you in the next one.